I'm continuing the conversation around the fixed income market with Eromosele Aziba, who is one of the investment analysts at Afrinvest. Thanks for being here. I'm sure, of course, you folks are looking at a report sometime next week. But first, let's continue. How do I read the Debt Management Office, the Central Bank playbook in the new year, looking at the auctions that we're expecting, which is monthly? Of course, this week, let's see whether the DMO will roll out January auction. We've seen the savings bond auction for January already, so we're looking for, and then the DMO is done. The central bank has started the new year aggressively mopping up. They've mopped up, central bank has mopped up almost $1 trillion already, while the stock market has gained $1 trillion. So I'm looking at how investors should be looking at all these government institutions, money managers, if you call them, both the DMO and the central bank, around my fixed income investing.
Well, like you mentioned, we've seen the CBN continue with its OMO mop-ups. But then again, it comes down to the individual investor. What sort of investment horizon are you looking towards? Do you have a more short-term to mid or longer-termed investment horizon? And investors will be taking note of rates at the market and yields, movement in yields. What end of the market would be best to enter? So for us, we would advise an active investment strategy, where, as opposed to what we have, where a lot of investors in fixed income market are adopt a more passive investment strategy, just buy and hold till maturity. There will definitely be opportunities within the year for certain investors to
I've gotten a few folks who are off the street asking me whether she should do mark to market or should they hold short when they're looking at treasury bills, because they're looking at into yield and those. What's your advice for local retail investors here?
Well, like I mentioned, so for treasury bills, currently, because of the rates that you have in the market, holding to maturity won't necessarily be a bad thing, except you have other, but that doesn't take away from the fact that there are other investment opportunities out there. So, for instance, investing in equities, where we've already seen significant gains. What we'd rather advise is having some sort of balance between both of them. Investing in fixed income markets. If you want to do short term, then you can do treasury bills. And then you can also have equities just to back that up.
What do you think retail investors are looking for? Yes, everybody wants to make money, but again, there's something you're looking at in the economy. So the fundamentals of the economy itself, we have reports that there's a very strong uptrend in Nigeria's business confidence, for example. If we're taking that away from the last report of the Central Bank of Nigeria, whether it's the PMI or the third quarter 2017 GDP, that business confidence is actually increasing. Do you think Nigerians feel a lot more confident that the economy, the business environment is improving? The survey from the Central Bank of Q4 2017, I'm reading from what FBN Questa pushed out this morning, that the survey showed that Nigeria's business confidence is improving at 17.7%. Much better in positive reading, against a negative 29.0 reading in the corresponding period of 2016. So it looks like this confidence, is it something for me to consider whether I'm doing equities or I'm doing fixed income?
Well, yes, confidence in markets has significantly improved. I mean, even if you go back to PMI numbers, which gauges sentiment in manufacturing sector, since April, we've had consistent expansion. So yes, sentiment has significantly improved, and we can also see that in activities in the market. So in the sense that a lot of investors are starting to come back to the equity market, where risk is higher, but they're still willing to take that chance because they have a more positive outlook on the performance of the economy going forward, as opposed to what we had at the start of last year, where the outlook was rather negative. All prices still remained low, and we had this generally bearish mood around. But there's been a lot of optimism. So even looking at the macroeconomic indicators, we've seen the economy come out of a recession, GDP expanding in second quarter and third quarter, and we expect this to be sustained in fourth quarter. We saw inflation trend lower. We've seen external reserves surge to above $40 billion. So we've seen a lot of improvements. In the FX market, we've also seen stability. We've seen increased FX liquidity, which also makes it easier for business owners and operators to carry out their activities. So yes, confidence has improved. There's a generally positive sense out there, and these are also factors that we highlighted in our Outlook report that we'll be launching.
Yes, you're talking about the report. Give us some of the risks that are highlighted in your report. I don't have it yet. It's going to come out next week. I wish you give us a sneak preview. But it's okay. All right, we'll get a copy of that. But what do you consider? Are your risks outlook in tune with the rest of other research institutions or reports that are saying, look, pre-election is one, oil price is another one, a few apprehensions around insecurity, whatever part of the country you live in?
Well, we think one of the biggest risks, like you mentioned, is tied to political risk. So next year being an election year, as elections draw closer, we expect to see increased uncertainty in the markets as investors are trying to gauge what direction the economy will be going. Are we going to have, if there's some, are we going to have peaceful elections? Are we going to have peaceful transition or a continuation of the current administration? So that would be political risk will be another factor that investors will be looking at, although we don't really expect this to come into play until the second half of 2018.
A quick one on that. Do you think, therefore, if investors are looking at these risks, would they be, on the equity side, would they be selling in May and go away?
Well, what we expect is that this rally would largely be sustained in the first half of 2018. For the second half of 2018, we expect to see a more cautious play from investors, especially for equities.
What about fixed income?
So interest in fixed income markets could increase. We might start to see some upward movement in yields as well, given the higher risk in the market. So we might have investors start to price this into their valuation, and that could be another factor that could come.
In terms of what we plan to do with rebalancing and readjusting our treasury bills portfolio, do you think we should do that in first half or second half?
Well, now that we've started to see lower yields at the market, now will probably be the best time to do that for the government, as we've still seen a lot of interest